Vandenberg, Fund Manager of TaliMar Income Fund 1. Today, I want to address a common question that I'm getting from investors, and that regarding is how does the recent rise or the announcement by the Fed that they're going to be increasing the Fed funds rate another quarter point, how does that affect the mortgage fund? So before I get into it, though, I want to quickly explain who the Fed is, why they're raising interest rates, why they're combating inflation, and then kind of take all that information and talk about how that's going to affect our mortgage fund. So real quick, who is the Fed? The Fed simply is the government body really tasked, responsible for the general health of the U.S. economy. They're there to create a stable economy, and they do this by managing, or their main tool is by managing interest rates. Now, they're also tasked with government oversight of commercial banks. Now, they're not to be confused with the SEC or the Securities and Exchange Commission, which is tasked with oversight of mortgage brokers and with stock exchanges. And then you also have the Treasury, and they're really responsible for the inflow and outflow of money in the U.S. economy. So think Fed, think they're there to manage the health of the U.S. economy, and they do this primarily with managing interest rates. And the reason they use their interest rates is it's a good way of essentially adding fuel or taking fuel out of the economy. So if the Fed feels that the U.S. economy is going into a recession, they may want to lower interest rates so that individuals and companies can borrow more money at a cheaper price and go out and buy goods and services, in effect increasing the GDP or increasing the activity within the economy. And the reverse is same true. If the U.S. economy seems to be overheating, they can increase interest rates, make it more expensive for individuals to borrow money or companies and go out and buy goods or services that will slow the U.S. economy down. So to use that in kind of real terms, how does that work? So imagine back in about 2007, the U.S. economy is slipping into a recession. The Fed decided to lower interest rates, making it cheaper for individuals and companies to borrow and go out and buy goods and services. In our industry, that made it cheaper to go buy real estate, and really that propped up the value of real estate. Now, all good things must come to an end. With the Fed keeping interest rates at near zero levels, the result was an immense amount of capital coming into the economy. The problem occurs is when there's inflation, and inflation is a result of more capital in the economy than there are goods and services to actually purchase. So if you have a lot of capital chasing after a set amount of goods or services, the price of those goods or services go up, and as a result, you have inflation. Essentially, you, me, go to the grocery store, and it becomes more expensive to buy groceries, or more expensive to go buy gasoline for the vehicle, or even to buy your vehicle. So that is a direct result and causes inflation. So to combat that, the Fed will increase interest rates, hoping in an effort to take money out of the economy and to lower the price, or at least lower how quickly the price of goods are going up. In doing research for this video, I came across a great quote by Milton Friedman, and I want to read this. And it's, inflation is always and everywhere a monetary phenomenon, in the sense that it is and can be produced only by a more rapid increase in the quantity of money than in output. And essentially, what he said, reiterate, is what I said, is that when you have an increase in capital in an economy, then there are goods and services available for it. That's when you have a rise in prices. So the Fed recently has stepped in. They're still concerned about inflation. 2022, remember, inflation peaked at about 8.5%. That's when the Fed stepped in and started to raise interest rates. They've been able to push down inflation to about 3%, according to the recent study for June 2023. So they've done it well. They've been able to get inflation down without running the U.S. economy into a recession. Chairman Powell's in a difficult position. Obviously, he's got to raise interest rates to bring down inflation, but he can't raise interest rates too far to drive the U.S. economy into a recession. Thus far, we're at 3%. Seems to be doing well. He decided that another quarter point might get us down to his target rate, which is about 2%. So we're almost there. Don't anticipate, and this kind of goes into where do I see inflation or interest rates going in the near future. I was 50-50 this time around if the Fed was going to raise interest rates, simply because they did skip raising interest rate during the last meeting. So they have raising rates 11 out of the last 12 times, skipping it last time, but raising interest rates this time. So all of this information, how does it impact our mortgage fund? Well, let's talk about what's the immediate impact. Number one, the immediate impact is that it increases the cost of our credit line. So as I had mentioned, or as I've talked about in the past, our mortgage fund has a credit line. We have a $5 million credit line, and it's really used for cash flow purposes. So for example, let's say we have more loans coming in than we have investor capital come in. We may borrow from our credit line to fund those loans, and then we pay down the credit line with either more investor capital coming in or with loans being paid off. And that's really helpful, because really what you don't want if you're a mortgage fund is to have what we call idle capital on the balance sheet. If you have idle capital, that means it's not invested and it's not earning you, the investor, any money. So you want to make sure you have as little capital as possible, but to ensure that you can manage the business and operational costs, but as little capital as possible, idle capital on the balance sheet. You always want to invest it in loans. So that credit line allows us to be more flexible in bringing deal flow in, payoffs, and investor capital coming in. So how does that affect it? The cost of the credit line is going to go up. Good thing is we have a zero balance on the credit line, so that's not going to have an immediate impact in terms of returns. Number two, does that mean that we're going to be able to increase the interest rate of the mortgage fund or the return of the fund? And obviously the return of the fund is predicated on my ability to increase the interest rates that I charge my clients. If it was June of last year, I would say the answer is yes. It's not that case anymore. And I would say that because of June to December of last year, there was a lot of concern with the rising interest rate that the U.S. economy was going to go into recession. Well, that didn't happen. But what happened was that a lot of institutional capital pulled out of the market, especially out of the private real estate debt market. So there wasn't, the amount of competition I had from other sources of capital had decreased significantly. About January timeframe, you started to see institutional capital coming back into the market. People were not as concerned, or these investors were not as concerned about the economy going into a recession. And then number two, the returns that you could earn in the private real estate debt market had increased significantly, so people wanted to get in and take advantage of this opportunity. And then when you take kind of the third portion of it, with local and regional banks starting to really pull back the amount of lending that they were doing, that opportunity within the private debt space, increased even more, bringing more capital in. So what does that all mean? Brock, you're telling me that you can increase rates, you can't increase rates. Well, with the amount of capital that is entering the space right now, it's really difficult to be pushing rates up to our end borrower, and that's because, again, the amount of competition out there chasing these deals. So I don't see a significant increase in the returns that we're going to be able to get to the borrower. I would just say that the floor, or kind of what everybody is charging, definitely has materialized, and that the target return for the fund at 9% is probably a lot more in line now with what we can achieve, especially versus late last year, where we kind of were in the lower 8% range. So my answer is it helps in the sense of rates are definitely not going to go down, but I don't think they're going to go up considerably. And then the third point I really want to talk about is, what do I think values of real estate are going to go down in the markets that we lend in. So this is really important because I really kind of focus obviously in the markets that we lend in, and that's Southern California, really specifically San Diego, because of rising interest rates. Consumers are being charged more for obviously the home loans that they're taking, and I would say again, you're not seeing that in San Diego and really most Southern California markets. The only thing you're really seeing is the amount of availability of homes on the market continues to decline, which I think obviously adds a buffer to any price declines you're going to see in the housing market or general real estate market. Again, I'm going to carve out office because it has its own issues. But the type of product type that is securing our loans, single family, multifamily, and some small balance commercial like retail, warehouse, industrial, I just don't see it really negatively impacting the value of that asset. So I'm confident long term, again, in the markets that we're lending. I don't think rates are going to go up considerably moving forward. So I think that I am I know that I'm confident on the assets that we're securing our portfolio on. So those are the three main ways that they're going to affect the mortgage fund kind of in the short to medium term. Longer term, it just shows that the amount of opportunity there is out there with local and regional banks really pulling back. The amount of funding that they're doing just continues to grow the opportunity for a fund like ours to put money out. We're seeing that deal volume continuing to trend up. Being that we're a direct mortgage lender or mortgage fund, we become kind of the first call for people that are looking for private real estate debt, and our marketing has really been boosted, the amount of deal flow that we're seeing, the amount of looks that we're seeing. So I talk about what we're going to see long term. Again, I think rates are going to continue to maintain here, maybe another quarter point. I give it a 25% chance the Fed goes up another quarter point versus 75. No, I was 50-50 last time. I was wrong. But again, I just don't see with where inflation is today that there really is a motivation by the Fed to take a chance with another rate increase. I still see huge problems with small and regional banks as they try to keep liquidity on their balance sheet, pulling back the amount of lending that they're doing. And that's just going to open up opportunity for a mortgage fund for us. So with that, I wanted to answer that question about how the quarter point raise is going to affect the fund. If you have any further questions about how it's going to affect the fund, please reach out to me. I love chatting about this stuff. Got my contact information below. If you're interested in learning more about the mortgage fund, go ahead and put some information to our executive summary. I recently updated it with our numbers. And if you're ready to get invested, by the way, we are still offering that $500 promo credit. So if you invest $100,000 in the fund, new or existing investor, we will credit your investment of $100,000 an additional $500. We have that through the end of this month. There could be a good chance, though, just based upon the deal flow or loan volume that we have, that we're going to be pushing that into next month. If you have any questions about that, contact my investment relations team. If you're interested in learning more, you're interested in what you heard today, and you're interested in hearing more about this type of stuff, subscribe to my channel. I try to post videos at least once a week about what I'm seeing in the economy, what I'm seeing in the housing market, and in the private debt space. Go ahead and subscribe to my channel and make sure I push out some more content to you. So great. Thanks for listening, and I hope to hear from you soon. Thank you.